Shipping isn't necessarily top of mind when it comes to looking for investment ideas. The market has a very narrow definition of quality and risk. Historical cyclical businesses like shipping companies are generally deemed out of favor. But if you're willing to look at some non-obvious places in the market, you'll be quite surprised at what's out there and what you'll find. Our philosophy and process has led us to some excellent opportunities in this out of favor segment in the market. Shipping has been very profitable for our clients, but it also demonstrates our full global capability and how it works in practice, from idea generation to research and finally portfolio implementation.
PSG Asset Management's philosophy is focused on looking at areas that are unloved and uncrowded and trying to find quality that the rest of the market has missed. We then take these opportunities through our 3M process. That involves an assessment of moat, management, and margin of safety. The moat and the management is essentially a score on quality, and then we focus on price, being the margin of safety, which is essentially a comparison of our intrinsic value versus where an asset is priced in the market. Industries that are subject to significant capital cycles and where that capital cycle is in our favor in the form of a constrained supply side has typically been a really good hunting ground for our longer term counter-cyclical investment process and approach. These capital cycles can play out over many years, can be extremely painful if you're caught on the wrong side of that capital cycle, but if you do get it right, it results in significant increases in pricing power. That translates through to very good returns on investment and exceptional earnings, and ultimately can drive exceptional shareholder returns over many years. We aim to invest at that point in the capital cycle where return on investments have been very subdued for a number of years. This results in reductions in both capex and investment, and ultimately this will translate through to reduced supply. At this stage of the cycle, profits are low and have been low and declining for many years, and share prices are really subdued, making it incredibly difficult for most market participants to invest at this time.
When looking at capital cycle driven opportunities, we spend a lot of time understanding the key characteristics of the industry and building conviction in the direction and the potential inflection of the underlying fundamentals. In shipping, a reduced supply of ships was the most important factor and the most overlooked. Returns are typically high when ships are in short supply, and in turn raises ship values, which means the value of your whole fleet rises. But a sustained period of high returns typically leads to over-ordering, which then deflates returns and ship values.
Given shipping's relatively short cycles, it has provided us with a masterclass in capital cycle analysis in a short space of time. We saw the rise of the Chinese economy in the early 2000s, which gave rise to a dramatic increase in ton-mile demand across all forms of shipping, especially dry bulks that transport commodities. This led to a surge in day rates in a supply-constrained market. As a result, the shipping industry started ordering more ships that by the time they hit the water, we experienced a decline in demand, which in turn gave rise to the following decade of stress in the shipping industry. Companies in the sector experienced bankruptcies, cash losses, and we saw increased scrapping of an oversupplied market. Counterintuitively, or maybe ironically, these events laid the strong foundation for future investment opportunities.
Clearly, this journey is not as simple nor as clear-cut as investors would really like. Even with a constrained and long-term supply-side thesis, changes in assessments of demand can create significant volatility in share prices. And so it's really important that we take this into account when investing in these long-term capital cycle type of theses. The way that we do that is ensuring that we are cognizant of the risk associated with each mandate, and we size our positions accordingly. We also take a long-term view, which is incredibly important, because when you have the periods of share price weakness, that long-term view, especially if the constrained supply side thesis is still in play, allows us to use those weaknesses in the share price to add to our positions. And this compounds through to very, very good returns over time for our investors.
So let's start at the beginning of our shipping journey. Our shipping journey actually started locally when researching locally listed logistics company Grindrod Limited over the past 2 decades. The main attraction there was the appraised value of the ports and terminals business, and we eventually implemented that in our portfolios late 2015, early 2016. However, it did require a good understanding of its shipping subsidiary Grindrod Shipping, which by the time experienced a dramatic decline in profitability after making super profits in the 2003 to 2008 period. So back in 2016, we spotted a multi-year capital cycle building in dry bulk shipping. Back then, the order book was at plus 25-year lows, and there were several barriers preventing order of new ships and enforcing capital discipline. We did detailed analysis on a company called Starbulk, a US-listed dry bulk company, and eventually implemented in our portfolios locally and globally in 2016. So by the time Grindrod Shipping spun out of Grindrod Limited, we were already able to demonstrate attractive asymmetry in the long-term fundamentals and valuation, and we were happy to remain shareholders. We also did work on other segments of the shipping industry and identified similar supply-side opportunities in container shipping, which led us to invest in Maersk back in 2018. So our sell decisions are generally premised on when we believe there's insufficient margin of safety, which means there's a lack of asymmetry between the potential range of outcomes. We will then typically look at other more attractive opportunities and reallocate the capital.
It is never plain sailing in the shipping industry, and our patience has been tested. Share prices remained depressed between 2016 and 2020. But in the background, importantly, the fundamentals continued to improve as fleet growth continued to slow. We saw increased scrapping and increased environmental regulations caused further trade inefficiencies. But then the pandemic hit in early 2020, which caused an unprecedented collapse in demand, applying significant pressure onto the shipping companies and their share prices. Importantly though, March 2020 turned out to be the cyclical low of the shipping industry, and share prices have recovered well since.
As a rule of thumb, trade inefficiencies drive shipping ton miles, and the pandemic was a key inflection. We saw container shipping rates and share prices go up fourfold over that period, but consequently it led to a period of over-ordering and yard capacities were filled up to 2027. And hence we couldn't justify a margin of safety in holding our position in Maersk, and we fully exited in 2021. So despite a very profitable period and chunky dividends post-COVID, we elected to remain invested in the general shipping complex for 3 main reasons. Firstly, we were able to sustain conviction in the supply side. We still had yard capacity being filled out to 2027, and environmental regulations were keeping a lid on new supply, which gave us a lot of optionality to an extended cycle. Secondly, companies pivoted to very shareholder-friendly capital allocation policies. For example, Starbulk elected to pay out all its excess cash, which led to dividends of multiple times our initial investment. And thirdly, we were still able to demonstrate attractive asymmetry in the range of outcomes, and our valuations was heavily weighted towards near-term cash returns to shareholders.
In early 2022, we added meaningful exposure to our crude and product tanker stocks that made it through our 3M process, meeting the criteria we discussed earlier. Again, the supply side was the key attraction to our shipping thesis, and the disruptions to global energy markets from the Russian sanctions proved to be the key event, which led to increased ton-mile demand and caused further trade inefficiencies. That demand ultimately easily outpaced the fleet growth that we saw at the time. What followed was an unprecedented sequence of favorable supply and demand disruptions in an already tight market. We saw the Red Sea shipping crisis. We saw the global cargoes being rerouted away from the Panama Canal. And more importantly, which is now a structural issue, we experienced the increasing distance of refining capacity to its customers. Importantly, since 2022, these conditions led to our core shipping holdings in the product and crude tanker space, Scorpio Tankers and Euronav, to deliver total shareholder returns that were multiples of our initial investments.
Yes, we also had a fair bit of corporate action. 2022 marked the end of our journey for Grins Shipping when one of its competitors made a competitive bid for the company. We decided to exit and reallocate capital to other more attractive segments. And 2023 marked the end of our journey for a year and a half when John Frederickson's Frontline made a compulsory bid for the company at a very fair premium, and we elected to exit.
During our shipping journey, we have also come across and witnessed numerous examples of astute capital allocation by strong management teams. And if I digress for a moment, if you have a cyclical type of business like shipping, you combine it with assets that are cash generating, even through tough periods, and a strong and astute management team that understands capital allocation, you can have massive shareholder returns driven by the confidence of those, and you can have exceptional per share returns in particular. And unfortunately, that's not something you can capture on a normal Excel spreadsheet. That optionality is something you need to understand, research, and take into account. Now, we actively seek out these strong management teams that are astute capital allocators, and we refer to partnering with them. And that's because we take a long-term view, but also these management teams are often significant shareholders in their own right.
To make it tangible, management teams across our shipping companies took advantage of cyclical pressures in the industry and bought second-hand ships at depressed prices, and also opportunistically bought back stock at low valuations. This had a transformational impact of adding significant value to their fleet and to free cash flow on a per share basis in an upcycle.
Our shipping journey demonstrates quite clearly both our philosophy and our process in action. After we get to know and understand the fundamentals of an industry well, we can start to look at adjacent stocks, sectors, or even geographies for further opportunities and ideally even better opportunities. Alongside shipping, we've been able to successfully exploit numerous other industries subject to capital cycles over the last decade to the benefit of our investors. And going forward, we'll continue to look in these out-of-the-way areas and unloved, unappreciated areas of the market for further opportunities for our clients.